Two companies recently, MicroStrategy and Square, recently plowed just under $500 million into Bitcoin. Michael Saylor, the co-founder of Twitter and Square, said, "We just had the awful realization that we were sitting on top of a $500 million ice cube that's melting. The corporates are coming for Bitcoin, yet it's still considered a bit fringe for everyday investors to take seriously." Well, there's another thing that you should start to begin to at least try to take seriously also. That's the whole world of decentralized finance, or DeFi. My name is Darcy Ongaro, and you're watching the NZ Everyday Investor. In today's show, I sit down with Wellington-based blockchain renaissance man Mark Pascall, and we talk about the epic rise of decentralized finance. We discuss why DeFi applications have been going ballistic and how New Zealanders can buy into it. And we explain some of the risks to consider also. We're also going to be talking about central bank digital currencies and the dangers of big corporates like Facebook printing their own big digicash themselves. In the broadest of terms, DeFi is a financial system built on the inherently shared nature of the blockchain. Because these systems aren't owned by any one person, they're virtually impossible to be soiled by personal interests. The reason I'm keen to have this discussion today is that with any new creation, especially in the realms of finance, there's going to be some destruction as well. And it's important to me that you hear about it in ways so that you can be the beneficiary of the creation without being a victim to the destruction. The two biggest mistakes, in fact, that you can make around this topic is to get too involved too soon with little or no research. There's no 0800 number out there in the wild world of DeFi, so don't invest anything that you may need in the short to medium term. The second mistake, though, that you can make is that you could disregard it completely. Don't do that. There's something in this. Now, before we get started, I'd like to mention our special partner, Hatch. Hatch makes it easy to get your money to work for you in share markets. Check out the link in the description, and if you sign up to Hatch and set up a new account there, put $100 in, they'll throw another $20 on top of that. So without further ado, let's get started on today's show. Hey, welcome to the NZ Everyday Investor. My name is Darcy Ongaro, and today we have a really special podcast because we're talking about basically money Legos, or what is the future of finance. Super, super important if you're looking to build wealth in the new world using new ways. So today, my special guest is Mark Pascall. Thank you very much for joining us today, Mark.
Hi, Darcy. Good to be here.
Cool. For our listeners, just so they know how you kind of fit into the old ecosystem and what you do, can you just give us a bit of a background as to what your history is?
Yeah, it's been an interesting journey for me. So I used to run a software services business. So we used to build web and mobile apps, but part of my role there was to look into new emerging technologies. So I went to this conference about 7 years ago on Bitcoin and really knew nothing about it before that, but spent 3 days immersed in it and met some of the key international players. And kind of by day 3, the penny had dropped, and I sort of realized that this was much more than a new technology or a new currency, but something that had the potential to really change how society operates. So I got back to Wellington and sort of decided to pivot the company, and so we morphed into a company called Blockchain Labs and specialized in smart contract security audits. And this is back in 2017 when there was this crazy hype cycle around all things blockchain and this thing called an ICO, initial coin offering. So we kind of found ourselves in the right time, the right place, and picked up a huge amount of international security audit work, and so really rode that wave. I also, during that time, organised a couple of blockchain conferences in Wellington and Auckland, and for the second one, managed to persuade Vitalik Buterin, the founder of Ethereum, and Andreas Antonopoulos to come over. So spent a very interesting week with those guys. Last year, I had a bit of a change, did a bunch of things around the Blockchain Association of New Zealand, presented to the Science Innovation Select Committee at Parliament on why we should be doing more in the space. Got involved in writing a book on decentralization. Ran the first university course in the world on DAOs, decentralized autonomous organizations, and got involved in a whole bunch of DAO communities, including Metacartel Ventures. And now just started a project at the GovTech Accelerator program in Wellington to look at using community currencies to kind of reimagine our social welfare system to empower some of our most vulnerable and disadvantaged. So that brings me up to date.
That's cool. That's a lightning fast introduction. Thanks for that background. And you mentioned a couple of things which we are going to go into for our listeners. Don't freak out. We are going to cover off what these things are, like what is a DAO, decentralized autonomous organization, CBDCs. We'll cover that. Cryptocurrency, blockchain, all these phrases we'll unpack a little bit. And in terms of a place to start, you mentioned that you do a little bit of work in terms of consulting in the private and in the public sector. What is the general sort of vibe that you get when you are kind of mentioning blockchain type topics to everyday kind of Muppets who don't necessarily know anything about it? What's the general sort of look on their face when you talk about it?
I think most people are really intrigued. It's quite a mind-bending topic, and they're keen to learn. Generally, and I found in the public sector in New Zealand and in the big corporate sector, there's a lot of interest, probably not a lot of action. It's probably important to understand there's two types of blockchain. There's the permissioned or private blockchains, and this is where groups of organizations who don't quite trust each other sort of collaborate to build a system where no single player has control. So there's a reasonable amount of interest in the government and corporate sector in that, in the context of supply chain and provenance. So there's quite a lot of work in that space, but I'm not so excited about that space. I'm more excited in the permissionless, open, public blockchains like Bitcoin and Ethereum. And there's not so much, if any, sort of serious projects, I would argue, in the sort of big corporates, or it was a shame. I think this is the most interesting and disruptive part of this whole thing.
Yeah, and we'll get into that in a little bit more detail soon. But am I correct in assuming that the rate of change, whether it be government or whether it be in private institutions, the rate of change is, at best, it's a positive progress, but it's kind of a linear sort of process, right? Whereas we're talking about a technology that is very much exponential. Is that kind of one of the things that potentially these players, they don't really grasp that this is actually happening?
Yeah, I think so, especially in recent months when we see DeFi just to sort of go a little bit exponential. But having said that, we've got to be careful. There are these hype cycles, and we don't know whether sort of the current DeFi interest is going to sort of crash down again or just continue up on its sort of trajectory. So you need to be a little bit careful. But you're right. It's generally in the sort of traditional systems. There's a lot of infrastructure there. It's hard to change, and it's hard to sort of start re-architecting in such a different way.
Okay. So tell me then, just for background for our listeners, what is Bitcoin, very briefly, of course, and how it relates to Bitcoin in the blockchain piece, and then we'll talk about other cryptocurrencies and decentralized groups after that. So do you want to just start with what is Bitcoin, just to introduce the whole topic of blockchain?
Yep. I'll try and do my sort of very quick intro, but it is a sort of big topic. So essentially, Bitcoin was this experiment that was launched by this anonymous person called Satoshi Nakamoto about 11 years ago. And he or she produced a white paper that basically solved a problem that had been going on for many years called the double spending problem. And this is this essential problem with digital assets, because they're trivial to copy. It's really hard to prove ownership of a digital asset. So if I've got a picture of a cat or something, a JPEG image, I can email it to you, but I might have 10 copies. I can copy it 10 times, you can. So we can't really prove who has ownership of that digital asset, and that's called double spending problem. So Satoshi essentially, and I guess the way society has solved that problem is by using trusted intermediaries. So essentially, in the case of a digital copy of a digital cat, a JPEG image, we ask a trusted third party to create a ledger, a list of who owns digital cats or digital anything, and we use that centralized trusted third party to manage that, because we don't trust each other. So that's kind of how our whole global finance system has grown up, around that reliance on trusted intermediaries, our banks, financial services, everything. But Satoshi 10 years ago basically solved the problem and found a way to allow me to transfer a digital asset to you without needing a trusted intermediary. So and the architecture that he created, we now know as the blockchain, which was kind of this combination of gamification and cryptography and a few clever things that hadn't been really put together before in this new way. So that's what he's basically outlined in this white paper, and defined this experiment that we now know as Bitcoin as this currency. Initially, he sort of touted it as this type of new form of currency as an experiment. But yeah, it just grew from there, and people started, and essentially Bitcoin is a sort of set of incentive structures that incentivize people to participate in the system, and Bitcoin has now grown to market cap of many billions of dollars and uses more electricity than many small countries. And but it's important to understand that Bitcoin is just the first sort of implementation of a blockchain. Since then, because it's all open source and it's very easy to copy, many people have created other blockchains. They've either just copied Bitcoin and changed it a bit, or they've created quite different blockchains like Ethereum and sort of second generation blockchains.
So it's kind of like this, I guess Satoshi, I can't even say it. Satoshi Nakamoto. There you go, Satoshi Nakamoto. Yeah. So he's kind of like this Promethean figure, right? Where he comes down from on high, he creates a tool, he gives to people what they need, which is an alternative to the centralized financial system where you have to have this trusted intermediary, and depending on how well you trust them, I guess, is another story, and the cost associated with that has to be considered. So he's given us this permissionless, open source, distributed ledger, or a distributed way of seeing where everyone sits, where we can see it simultaneously, thereby, I guess, solving that double spending problem. That's basically, in a nutshell, I guess, the architecture or the path that has been given to us. But now that path has been, I guess, walked down so many times by other people for other purposes that now enter into the equation other things like Ethereum and other types of cryptocurrencies that are doing different things, but using the same sort of architecture, right?
Yeah, I think it's important to understand, and it's not, Bitcoin is a hard concept, but in some ways it's quite simple in that. So our traditional way of when we use a trusted intermediary like a bank, they have a ledger, they have a list of transactions, and that's how your bank knows, who owes what. The blockchain kind of works the same way. It has a ledger that just records every single transaction, and it's a very long ledger. But the big difference between the blockchain, Bitcoin ledger, was that it was decentralized. So basically, instead of having one copy that sitting on your bank's server infrastructure, you have lots of copies, and anybody can join the network and essentially get a copy. And the system, the cleverness is essentially where the system just synchronizes all those copies. So you've got however many tens of thousands of computers around the world in the Bitcoin blockchain, all constantly synchronized. So if I give you a Bitcoin, that goes onto the ledger, and within 10 minutes, it's propagated all around the world. So that's a record of that transaction is on lots of computers, and that is quite a fundamental sort of shift, because now this gives it two quite unique properties. One, that there's no central control of that system. It's a peer-to-peer system. There's nobody in the center, nobody to put in jail, no way to stop it. But also, when the data goes in, it becomes essentially immutable, unstoppable. So you can't change that data, because if you think about it, in order to hack into it or change the data or bring down the database, you'd need to hack into all, or at least 51% of those computers all around the world, and that's really hard. Right. So yes, so that's kind of, but Bitcoin was this first experiment, very narrow in scope. It was just designed as a currency with this ledger, this sort of distributed ledger. What happened next was this guy, Vitalik Buterin, created this Ethereum concept, which was a brand new blockchain, which not only decentralized data, i.e. the ledger, but it also created a system where you could decentralize business rules, so code. So if this happens, do that. Lines of code could also be put onto this decentralized system. And it kind of turned into this global decentralized code execution engine. And the big breakthrough there is that once I put my code, my set of business rules onto that network, and it becomes decentralized, then we can all guarantee that code will be executed as programs, so nobody can stop it. No corporation, no government.
Code is law.
Code is law, and that's what we now know as a smart contract. And that enables us to build dApps, so decentralized applications, and DAOs. And if we put a bunch of applications together, we can actually create organizations with business rules that run those organizations all as smart contracts.
Right. So let me just back up and make sure I get this really clear. So we've got Bitcoin, which effectively is digital money flowing through a blockchain. Very simple, right? It's like kind of like one-dimensional. But now we have, say, Ethereum. It's multi-dimensional because now you have these blocks of code that are kind of like a massive supercomputer, right?
Yeah, it acts as this sort of global code execution engine. So any developer can just cut and paste some or write some code, put it onto that, and create something that is decentralized out of the box. Before Ethereum, you'd have to sort of, if you want to create a new blockchain or a new decentralized application, if you weren't using the Bitcoin infrastructure, you'd have to persuade thousands of people to install your software and create this whole network. So with Ethereum, the network's already there. All these computers are running around the world. You just plonk your code on and it runs.
Right. So, and was the whole ICO thing quite instrumental in getting this, I guess, like specific to the Ethereum network? Was that quite essential in terms of getting mass adoption, was to create kind of like a token, a currency that people were kind of speculating on, but by default, they actually built a network as a result. Is that kind of how it works?
Yeah, kind of. It was the ICO phenomenon was a slight anomaly, I think. In hindsight, it was touted as this sort of. Remember, Ethereum was, certainly back then and still is relatively new, but people suddenly realized it could be used as a mechanism to sort of democratize capital raising, because you can essentially spin up, make your own token. You could mint, 1 million of them, however much you want, however you code it, and then you can go to the world and say, hey, I've got this really cool idea that is intrinsically linked to this token. I'm going to keep 10% of the tokens. I'm going to sell 90% of the tokens to the world for an existing cryptocurrency that has value now, like Ether or Bitcoin. So essentially, people send their Bitcoin or Ethereum in exchange for this new token that will have future value. So that essentially gives me a mechanism to raise capital to fund my new project that often hasn't been built. But I think in 2017, people got a bit carried away, and so there's a real FOMO. And it was a bit like the dot-com sort of bubble of 2000. Everybody got a bit excited, and there was lots of bad ideas, it turns out. And that sort of came crashing down in 2018 when people realized most of these ideas weren't actually very good. They're either dumb ideas, they were scams, or their time they were just too soon, right? Yeah, too soon in a lot of cases. The idea was good, but people didn't really cotton on to the fact that the technology was still, and it still is to a degree, too slow, too expensive, and that is still the problem with the current sort of generation 2 blockchains. Typically, they've quite a low transaction throughput, so relatively small numbers of transactions per second can go through, because it's got to be processed by so many computers at the same time. So there's some inherent limitations on what it can do.
Right. So you've got CeFi, or centralized finance, and to use a really simple comparison, if we wanted to send some money to somebody in England, we would be going through probably several intermediaries to actually get that currency translated into their bank account for them to use. That's centralized. That's where we're trusting a third person, CeFi. Whereas DeFi, decentralized, it's distributed. Everybody who uses it has a network, I guess, built in. Is that right? So it's kind of like simultaneously replicated at the same time?
Well, I think the big difference is that our current CeFi system is based around centralization, but also it's based around 200 odd countries having separate systems, and so you've got to for me to send money to the UK or to some other country, you've got to sort of hop across these multiple different systems and settlement layers and all this sort of stuff. Whereas in theory, in practice, if I want to send you somebody in England some Bitcoin, it's just one system. We're just changing one ledger entry and one database that we both believe holds a source of truth. There is nobody else or no other ledger, no other synchronization that happens. So it's just a much simpler, more more elegant system in a global context.
Yeah. Okay. So if we were to talk about, how a DeFi organization or a decentralized financial organization works compared to a bank, there's no real comparison really. To me, it feels like it's so foreign that I would assume if I was a bank, I'd be looking at this as some sort of scam, hopefully, which will go away. Or I guess the longer it persists, the more I keep hearing about this, the more anxious I'd probably start to feel as a bank, because this isn't something necessarily that you could bolt on to these existing legacy systems. This is a complete different way of doing things where you fully let go of all control, really, isn't it?
Yeah, and I think it might be a good point to just sort of drill down a little bit into, how our current financial system works and how different it is from DeFi. So
please, if you don't mind.
So essentially, our entire global financial commerce system is built on the premise of centralization, as I mentioned. Because we don't trust each other, we need these trusted intermediaries. So your banks, financial, everything, even the new disruptors like Uber and Facebook, they're based on this centralization model. But one of the problems is that with globalization, massive scale disintermediation going on, many would argue that these centralized trusted intermediaries have grown too powerful. So that's kind of one problem with the current system. And especially worrying is when the mega corporations, the Googles, the Amazons, the Facebooks, start to switch on their own currencies, which we know Facebook are working on, and their own financial products. That's, I would argue, extremely worrying, because we don't want corporate controlled money. The other problem is how our current system of sort of state money works. So the heart of finance is state controlled money currently. So every country in the world has what is known as a fiat money system. And so what happens is the state, the Reserve Bank in New Zealand's case, or a central bank, essentially issues money in a couple of ways. It issues cash. These are the notes and the coins directly to citizens. So, and bear in mind, this is now this is the only sort of anonymous form of money. So I can hand you a $10 bill if I'm in the same room as you, and it's not tracked by any centralized system anywhere. So, but it's the only form of money that we as citizens can hold directly. So that's the first form of money that the state issues to us as citizens. The second form is bank reserves. So the Reserve Bank gives essentially blocks of state-controlled digital money. They hand out this to this sort of oligarchy of retail banks, and so when we interact with our bank, we're essentially getting a different type of money. This kind of digital token is more like a sort of a casino chip in a way, because the bank has the opportunity and does give out more money than it actually has in its reserves. It's allowed to do that in the form of loans, etc. So when we interact with the bank, we're getting the sort of bank money essentially. And so one of the downsides is that in this tightly regulated sort of retail bank oligarchy system, that innovation is quite limited. There's been some innovation, so PayPal a few years ago, but even them, it's just a plug into the banking system. They have to have a bank account themselves. It doesn't really affect New Zealand too much, but there's also this huge issue for developing countries, as the banks aren't that interested in people with very low incomes, so that we have a big portion of the world who don't have access to banking services. So essentially, there's a couple of ways that the money is issued. There's interestingly a third form of state money that is being talked about around the world. I assume that they're talking about it in our Reserve Bank as well. And this is the idea of a central bank digital currency. So this is essentially where the central bank or the Reserve Bank issues state digital money directly to the public. So therefore cutting out the banking system.
This is the central bank digital currency, or CBDC.
CBDCs. So so there's a lot of discussion around the world, and it seems like a logical next step, but could be and will be quite disruptive to our banking system, but could open up a whole bunch of innovation. But even with this third type, it's digital, but it's still centrally controlled state money. It's not decentralized money.
Right. It might be programmable, but it's still centrally controlled.
It's controlled by the state. So we've got these potential three types of money. So the cash, which is disappearing quickly, so that's essentially going to go away quite soon, but the bulk of our money goes through this banking oligarchy, and that's one of the sort of a lot of people are worried about that, the sort of surveillance capitalism and etc. So the fact that every transaction will be recorded by a corporation somewhere. So some people sort of don't like that idea in principle. Also, there's a problem that's as I mentioned, our system is built around 200 different countries having their own system, but we're now living in a global village, that doesn't really recognize those boundaries, and we see that in the form of just lots of friction. I don't think it's realistic to have a global government running a financial system, and it's really bad idea to have a capitalist corporation running it. So what else can we do? And the logical answer is some sort of decentralized, community-controlled currency along the lines of Bitcoin and using the sort of blockchain technology. Right. That's where we're at. In my mind, it's really the only logical next step is to really sort of start supporting these decentralized currencies.
And do you think that the big corporates, the big government, do you think they're just going to roll over and let that happen?
I don't think so. I mean, we've got this current sort of power play. We've got state, we've got corporates, and we've got the sort of fringe, crypto, open source sort of anarchists on the third sort of leg of the triangle. So, and at the moment, the governments are kind of rallying against the corporate. I mean, when Facebook announced Libra, that their own sort of currency, a lot of governments sort of, got extremely worried and came down hard on them. And I haven't followed closely where they're at. But I mean, the reality is that because Facebook is a real company with real people they can put in jail, and so are all the other companies who want to be involved. So the government can sort of slow them down or possibly stop that from happening, because they don't want, our government, I imagine, doesn't want the Facebook Libra currency more widely used and more accessible and easier than our own state currency, because we'd stop using it, our own state currency, and that's probably not a good thing for our government. So in my view, what needs to happen is the governments now need to actually work more closely with the crypto folk and work together to sort of build up these genuine decentralized community-controlled currencies, and the government should ultimately support those, and so that we don't get taken over by these corporate controlled currencies, which I think is a far more dangerous state of affairs.
Sure. So the corporates might chase them into this, where they have to start adopting. Probably the first cab off the rank is a CBDC, central bank digital currency. But ultimately, that's probably the first battle. The real war is with the user, right? The real war is with everyday people who can now actually just download a wallet on their smartphone and start interacting outside of the corporate structure, outside of the government structure. What does that look like? And is that actually even possible?
Yeah. And that's what's really happened in the last, relatively recently. So cryptocurrency, the concept has been around for 10 years, but always in the fringes. It was always slightly flawed because in the case of Bitcoin, the volatility, so you couldn't really rely on it as a medium exchange. If your price of apples is changing by 30% each day, it's not much use to when you're buying apples. But I guess what's happened, there's been this sort of maturity in the DeFi space, really, and it really started off with the creation of stablecoins. So a stablecoin is a cryptocurrency that is pegged to a fiat dollar, so in most cases the US dollar. So and the initial ones were known as asset-backed stablecoins. So Tether and a few others. So Tether's probably the best known one. So, and that got over, that helps, address one of the main problems. I can use a cryptocurrency, I can use it on exchange or wallets, and I can do this stuff, and it won't change every day. It just pegs the dollar. So that was good, but it was still problematic because those asset-backed stable coins had to be created by a company that we need to trust, and basically they kept $1 in their bank account for every $1 of token that they minted, and we need to trust them that they keep their reserves. So
that's kind of like a de facto sort of custodian, right?
Yeah,
you could look at that as a custodian. They hold that dollar on your behalf. They mint this stable coin because they've captured your fiat currency. But that's kind of that in a nutshell, right? Like you got to solve that stability problem first.
Yeah, so that sort of solved the stability problem, but in this sort of hybrid sort of CeFi meets DeFi sort of weird space, because you've still got to trust a company that could be shut down or could run off with your money. So I guess the next fascinating step was the algorithmic stablecoins. So MakerDAO is a protocol that created DAI. So DAI is a dollar pegged cryptocurrency, US dollar pegged cryptocurrency. But that used very clever maths and algorithms and incentive structures to basically create liquidity from the market, so incentivize people to sort of loan money and create liquidity. And I won't get to the maths, but they've been running a while now and essentially created essentially a decentralized stablecoin, which is really cool. And then that really, once that had been sort of bedded down and people were comfortable that that's going to work, and in the last 6-7 months, that really triggered a whole wave of innovation around DeFi products. So borrowing, lending, insurance that could use that stable coin, could use all the benefits. And that's the thing that's really sort of taken off and gone from in the last 3 months, gone from 2 billion to 10 billion. And we see these amazing products that can essentially allow me to, using a stable coin, get interest, simple interest way above what I'm getting, 1% at my bank in New Zealand.
And this is the part that I think is a little bit probably surprising for some people to know, that you can actually already interact with a decentralized financial organization by just downloading an app, like a wallet. You move your money into a different type of currency, a cryptocurrency, and you can get crazy interest, like up to 25% is one that I saw yesterday when I was doing a bit of research. And I know there's significant risks, and we'll come back to that in a second, but it's already possible to lend your money out for a really good rate of return. It's possible to borrow, and it's also possible to get insurance. Those three things that you mentioned, which you kind of need if you're going to have an alternative to the current financial system. So, but that's actually a recent thing, is it? Like, that's not actually something that's been around for ages. That's actually something that we've only really seen in the last little while, right?
Yeah, absolutely. I mean, so MakerDAO, they had the basics in place because they actually had a sort of borrowing and lending platform as part of that stable coin. But just literally in the last few months, Compound and Aave and Uniswap and Nexus, there's a whole bunch of others that have sprung up. And again, these are all sort of, some have had problems and there have been some issues and bugs, but that's just a sort of sign of the maturity. These things really come in the last few months. So you've got to be careful. But what is interesting is this concept of composability. So when you a DeFi protocol is known as, it's by definition sort of open source and transparent and open. So in a traditional company, they might release something and they might put an API around it. They might allow other systems to interact with it, but they've got to open a gate. And the current open banking initiative around the world is trying to encourage the banks to sort of open up their systems via APIs. But with a DeFi protocol like MakerDAO, it's open by default. So you can think of it as like a Lego brick of functionality. So once it's out there, once it's on the blockchain, then anybody else can build something on top of that. They can stick a new bit of Lego on top of that and create something more sophisticated. Now the positive is that allows very quick innovation. The downside is that you get this fragility risk. If there's a problem in one of those base Lego bricks, it can sort of have ripple effects and cause the whole system to sort of go crazy. And there's been a few instances where sort of unintended consequences are being caused by a certain combination of Lego bricks being put together in a weird way that nobody anticipated. So there is this fascinating space where, yes, you can earn high interest. It's really difficult to quantify the risks. You can take insurance out with Nexus. So that basically says if there's a bug in the code, you'll be insured by it. But Nexus is itself a decentralized community. So, but I see this sort of gradual shift in public sentiment is that we'll start, as these things become easier to use and more people use them, we'll just gradually start to trust them. At the moment, your average person on the street is not going to trust this code.
And why would they? Why would they? It's so foreign, right? Like, I try to keep abreast of what's going on as much as I can, but it's just so foreign. It just doesn't sit right, because I don't get it. It's a completely new language, completely different concept. And I guess that ignorance is a bit of a built-in safety mechanism, because it is possibly fairly dangerous at the moment because of, what you said, that we don't really know what we've set free out of this Pandora's box. It could become something amazing, something beautiful, but it might come with some carnage along the way. Well, it will. And so for a moment, do you mind just talking to just some of those risks associated with, I guess, early stage adopters? If you were a user, if you wanted to, I guess, lock up some money, lock up some currency, and get a better rate of return to start there, what would be some of the risks that I would need to watch out for?
Yeah, I guess I'll just start with how you do it in practice.
Sure, definitely.
So it's actually pretty straightforward. So in New Zealand, we've got a couple of good exchanges that have been around, so Easy Crypto and Dasset. So they allow you to sort of convert your New Zealand dollars into some sort of base crypto token. Probably Ethereum is or Bitcoin is the safest. Probably Ethereum, because most of the DeFi stuff is happening on the Ethereum blockchain. But if you just wanted to sort of, so Bitcoin is kind of being used now as kind of a digital gold. It's probably the most secure, stable network. So it's not being used as a medium exchange so much. It's being used as a sort of gold V2. So you might want to just put some money in Bitcoin because you think it might go up eventually. But if you want to say earn some interest on your, say you've got $100, you go to Dasset or Easy Crypto in New Zealand, you'd convert your 100 NZ dollars into 100 NZ dollars of worth of Ether, or you may even put it straight into a stable coin like DAI. So it just translates to a US equivalent, dollar equivalent of DAI. Before that, you probably want to learn how to use a digital wallet. So I probably recommend MetaMask is probably the simplest, just a browser plugin. So you get MetaMask, you get your head around how MetaMask works. Watch a couple of YouTube videos on that. So then you get then the crypto exchange will just send your money to your digital wallet on your browser, on your phone. And then pretty much you can visit one of the DeFi protocols, so Compounds, Uniswap, Aave, are probably the sort of ones that spring to mind. And it will, and you press a button, then it will connect to your wallet. So it never takes control of your money until you tell it to, but you can basically connect to your wallet within the browser, and then you can trade. So you can swap your Ether, which is a sort of the most popular liquid cryptocurrency. You can swap that for one of these more obscure high risk tokens, and that will just swap it in, convert it. And put it back into your wallet. But what you can also do is to take out a loan or borrow some money or get some interest. So with your $100 of Ether or stablecoin, you can use one of these protocols to just put it in and get some interest from it at whatever interest rate is there. And there's even sites now, talking about this composability, there's even sites like Wyon who have basically, you give your money to, or you put your money into their system, and then they automatically find the best DeFi protocol interest rate out there.
Right, kind of like a fund manager, right? So they're kind of out there, and you put your money into that, and it just finds the best rate of return for that, and that's kind of all happening for you, so you don't have to think about it.
Yeah, absolutely. So back to the risks. There's a whole bunch of risks, and again, the important thing to remember is that once you get out of the centralized exchange, so the local exchange like Dasset or Easy Crypto in New Zealand, they have an 0800 number and they have people to help you. But once you're out from them into the sort of decentralized world,
you're in the wild, man. You're in the wild.
There is no 0800 number. If you stuff up, and there's probably no legal recourse whatsoever. If something goes wrong, the money's gone. And also, you do need to be comfortable with digital wallets and backing them up and keys and stuff, because the whole concept of a digital wallet is self-sovereign. So you and only you have control of your wallet. Nobody else does. So if you lose your backup phrase or your digital key, or somebody else sees it, they might have a webcam over your shoulder while you're doing it. If they see that, then they've instantly got access to your money and they can transfer it in a second. So you need to be careful with the whole sort of using a wallet and be aware of those risks. But but then there's the risks of putting into this protocol that is very new. I mean, some of these have really only been out a few months. They have got huge amounts of money in them. They've risen to sort of billions of dollars. Market cap in a very short space of time, and we have seen instances where things come crashing down. I think that risk will just reduce over time as more people use it, and there's more people looking at the code and trying to pull holes in it. But this is still, I probably wouldn't put in more than you can afford to lose, unless you're
definitely squarely in that category. No, which I guess it makes sense. Like when you look at the investors who have dabbled in cryptocurrency or who are into it, I guess the buy and hold mentality, as long as you can handle, like if you have good key management and you can handle it, that is where many people start and finish. Just the whole hodling mindset, because it is actually fairly straightforward once you get your head around it, and you're not sending your money anywhere, so you're less exposed to risk. But what you're talking about is actually going the next level, which does involve a lot more awareness. So it follows that we should kind of tread carefully as your understanding grows, right?
Yeah, and the other thing so a lot of the way these lenders and borrow, so that these interest-bearing systems work, is that it's actually a bit like a mortgage sort of broker. So you put in collateral, so you can borrow money by putting in collateral. So you can borrow a certain stable coin by putting in collateral. So instead of a house, you put in a certain amount of ether as collateral, and then they give you another coin temporarily that you can use for other things. It may be a stable coin that you can use. But if the collateralization ratio falls because your collateral reduces in value because the price of ether falls, for example, then the way these systems work is that they will automatically sort of essentially dissolve the mortgage and give you your collateral back, but minus a penalty fee. So they incentivize you to constantly just check that your collateralization ratio is okay. Right. So you need to be aware of that sort of thing. Otherwise, you get stung for fees. But in theory, in theory, they can't steal your money because no central party controls the money, but
you do need to understand what the rules are, right? So basically, let's say you have $1 million in the bank, you buy $1 million house. It's kind of the equivalent of, well, you've just put all your money into that house. But with what you're talking about here, we can take out a percentage of that money, kind of like in the form of a revolving line of credit, which we can then go to spend it somewhere else. So not all of your money is locked up, and that has a lot of benefits, I guess. If you are you cannot actually liquidate your holding for some reason, you need to park your assets somewhere, but you still need to access some of that resource for a period of time, so you can actually borrow against that collateral, right? Yeah.
And all sorts of ways you can leverage. If you feel that some of these asset classes, these tokens, are gonna, continue upwards, you can leverage that, and But it's a lot of it is gambling at the moment, unless you're really in the know, because there's little regulation, there's lots of manipulation going on. So you got to be careful.
And is that one of the reasons why the amount of money that's locked up in DeFi, in the DeFi world, why it's spiked up so significantly in the last few months? Is that because there is a lot of speculation going on because it's so new and it seems to be getting adoption?
I think so. I think we're seeing a sort of similar, and again, it's difficult to tell whether this is a bit of a bubble that will, but we see with these bubbles, they go up and they drop down a bit, but they sort of generally, if you zoom out, it's part of a much bigger upward trend, which is what I believe is happening. I think you just got to be wary that it could all reduce quite quickly, and has done in the past. So the price of Bitcoin. I mean, if you look at the price of Bitcoin, we've had these massive spikes over the last 10 years, and at the end of every drop, everybody, you get all the headlines saying, "Oh, it's gone now." But then you zoom out, and these spikes just become insignificant because the next spike is
just little road bumps. It's quite interesting because I was looking at that a little while ago with Bitcoin, and correct me if I'm wrong, but there was 2 or 3 other pretty significant bull runs, or I guess you'd call them bubbles, where they kind of inflated, then they collapsed, and everyone was kind of like, "Oh, that was it. That was done. I'm out of here. I'm not." But and I guess in the last year we've realized actually maybe that wasn't a bubble after all. maybe there is something in this, funnily enough. So if you don't zoom out.
And I think the other perspective is, if you look at the global financial situation, which, I'm not an expert in economics, but it seems a bit of a train wreck about to happen with all the sort of quantitative easing, etc. So, there's a growing school of thought that says, you should sort of, park some of your assets into this world just in case the main system starts to really go wrong.
And we had a lot of that. Like I was talking to quite a few clients from March onwards this year, and one of the biggest questions was, I've got some savings. Is my money safe in the bank? And then the next question was, I have a big revolving line of credit at my bank. Is that going to be taken away from me? And then the next question was, can my KiwiSaver balance go down to zero? Right. So there's all these kind of waves of fear that can come crashing upon us that can cause us to have this aha moment when we're going through it. But that's not often the best time to make a decision to enter into something new. Whereas when the coast is clear-ish, like it kind of right now, it's kind of stabilized to a certain degree. Now is probably a good time to at least consider the merits of putting some of your worth into crypto assets. Not that this is any advice or anything, of course, but if you were to do it, it's when things are actually plain sailing that you do it, not when you're in the heat of the moment. But on that, like, what do you think would be the next trigger?
I'm not sure there's going to be a sort of trigger. I think it's going to be just a gradual building up of trust in this alternative system, to points that, grandma and grandpa are just going to use it because all their mates or their friends are using it, and they don't know or care that it's decentralized or blockchain based or offshore or anything. They're just getting a better interest rate or a better service or a better user experience or whatever. So we're not there yet, but but I think there's going to be some carnage and some disruption along the way. And it'd be fascinating to see how the retail banks sort of react to this, and how they. I mean, they can react to the central bank digital currency sort of thing, which is probably going to happen soon. I don't know whether. The way the DeFi is going, that could, that it can move very quickly. So,
Hey, let's just swap tack a little bit and go. I want to go back to CBDCs, central bank digital currencies. And again, I'm just mindful of the rate of change with any organization is hopefully positive, but linear at best. Whereas what's happening in the DeFi space is an exponential shift. So if we were just to speculate, not necessarily on the timing and whether they will and whether they'll be overtaken by decentralized versions, which is a possibility, but let's just assume it did get rolled out. What would our future look like in New Zealand if we were all transacting using a central bank digital currency?
Yeah, that's a tricky one, because I don't even know whether our central bank, Reserve Bank, is seriously considering this. We know the big players, and I think there's a bit of a power play between China and the US, potentially to sort of capture becoming the world's digital currency. Both superpowers would quite like that, and I guess China would like to sort of erode its America's dominance, with the US dollar being the sort of the global currency. So I think that's why China has put a huge amount of and gone very pro blockchain and pro CBDC. So with their own version. So, and I think they're probably way ahead of anybody else. So if New Zealand did it, I think,
because effectively it's programmable money, right? You could create all sorts of rules to allow different people to spend it on different things.
It would certainly open up a whole bunch of innovation, in theory, to anybody to wrap around apps and services, and that was currently that they just, it essentially creates this sort of this open platform for innovation. If we did roll out our own sort of digital currency. But I don't know whether the economics of doing that in New Zealand, a very small country, when this global economy makes sense.
Yeah, let's just wait until either Libra coin comes out or there's a Chinese version or an American version, right? Let's just wait and see what everyone else does. But I don't know if that strategy in New Zealand is actually going to be a really good one, if I'm honest. Like, I think that this is the time where we do need to lead, where we kind of need to put aside the natural tendency to watch others do it first. We need to actually be leading, and we're small enough to be able to do that. But I don't know if we've got that leadership. What do you think? Do you think it could actually happen?
I often like to think that, being smaller, we're more agile, but don't know. I mean, I'm not personally in conversations with the guys at Treasury or Reserve Bank, so don't know what they're planning, if anything, around this space. But certainly I'd like to think, but I think this has to be, we need some political leadership.
Correct.
And I don't think we've had that.
No.
With all due respect to the current government, we haven't had that sort of tech leadership, that sort of minister of innovation, that some countries are better at. So it needs that top-down sort of banging heads together and saying, "Look, we're going to do this, guys," rather than just the initiative, coming out of the bank. I think.
Cool. Hey, now going back to what we talked about before, where we had this the MakerDAO protocol, and we actually did cover this in the episode long feels like a long time ago with Sam Blackmore, and completely didn't know what the hell it meant back then. Still vaguely don't know what it means either. But what I did get was the whole idea of locking up of an asset and then being able to, I guess, draw down on some of the wealth. Like I'm thinking about an amazing piece of art that is worth nothing hanging on your wall, but if you could somehow, I guess, turn that into a currency, awesome. I'm thinking about investing in New Zealand shares instead of my custodian. Like currently I use ASB Nominees Limited, I think, as my custodian to own my shares. If that was on some sort of token or something like that, wouldn't that be cool? What about a house? So what do you see happening here in terms of the next level? Because we can see this happening in the digital realm with different cryptocurrencies, how you can lock up ETH to generate DAI, stablecoin, do some fun stuff with that. Could it be possible to do the same thing with alternative assets like fine art or wine or a classic car?
Yeah, absolutely. And there's been a lot of work and a lot of discussion around this idea of a security token. So, broadly speaking, there's utility tokens and security tokens. So security tokens, essentially digital Ethereum-based standard ERC20 is the standard tokens that are linked to a real-world asset. It could be a painting or a building or whatever. So, and if we can sort of crack that, then if we can sort of create a legal, tie between those two things, then yes, we can tokenize anything. We can tokenize a building. We could use it to raise capital. We could create these sort of. We could. That token can go onto the existing crypto exchanges, which are all over the world, and somebody in India could buy $1 worth of a painting in Wellington or a building in Wellington or whatever. So we could create very much more liquid markets for sort of stocks, shares, assets, anything that has value. So that I think that will come. I think it's slow, probably quite glacial compared to everything else, because it requires a lot of legal stuff to happen. And because the custodial thing is the first thing that comes to mind, right? Like who's going to be the analog custodian in the physical realm? Because that's going to, someone's got to actually say that they have rights to hang on to that painting. So that seems like the most common sense thing to solve first. Is that probably one of the big ones? Yeah. And interestingly, there's a project. So I'm the GovTech Accelerator in Wellington. There's a project. I'll give a plug for Felix. So he's
good on you, Felix.
He's working on a project called Opoly to essentially create to tokenize property. So you can buy little blocks of a property. It'll be sort of linked to a real world property. So instead of selling my house on TradeMe, I could put it on that platform, and essentially people could buy little slices of it until it reached my sale price, and so sort of the infrastructure around that. So I think that project and others around the world, will gain more traction. But as I say, anything that needs to touch the existing legal system, it does move quite slowly. Anything that's completely on chain, and that's why the sort of DeFi sort of exchange, token-to-token exchange, and DeFi protocols that are purely on-chain, completely borderless. They can move at sort of lightning speed, and it's just gone crazy because they just don't need to touch the existing legal or banking system. They can just innovate and they can build on each other, and
And I guess that's kind of what we need. Is we probably need a country, potentially the size of New Zealand, for example, that actually adopts these things, holus bolus, and actually just gives it a go, right? Just to see, not just to see what happens. That's a bit reckless, but it kind of needs a uniform move all at the same time across a range of sectors, including government, right? Like I'm thinking, just what could a blockchain-based system do to existing government structures in terms of creating efficiencies and creating a smaller government?
Yeah, I think there's huge opportunities in a small country like New Zealand, in a small place like Wellington, even when you've got these close ties between the sort of public and the private sector and a thriving tech sector all within coffee distance. I think there's opportunities to really do something groundbreaking. But as I said, I think it needs that political leadership. And it does. It doesn't really. It's not a vote winner currently, if ever. So I can't see that happening anytime soon.
Okay, Mark, so we're almost at the end of the session, but do you want to just tell me about what you're working on right now that you're really passionate about?
Yes, I'm currently working on a project as part of the GovTech Accelerator program in Wellington with a few folk down here. And this is this concept of actually using some of the token economic and cryptocurrency learnings to apply it at a community level, so we can actually design community currencies that are localized. And this may sound like a weird thing to do. Why would you create lots of little currencies? But there's actually a lot of reasons to do that, and it's been done all over the world. And in Kenya, they rolled this out. So to create these sort of smaller circular economies that actually empower often many of our society's disadvantaged, vulnerable people, to actually incentivize them to work and support each other to promote collective well-being. So so involves in a bunch of people around the world and down here in Wellington to make that happen, and to ultimately reimagine our sort of social welfare system, which is very fragmented and bureaucratic and involves multiple agencies throwing money at people who have to deal with 50 agencies.
And where are you in terms of development of that? Still obviously at the idea stage?
So concept stage, building the team. We're going to be working initially with an intentional community, probably down here in Wellington, to sort of co-create the rules around that. So there are these existing communities that have shared assets, they have shared gardens, and they do a whole stuff together. So we want to sort of tap into those communities and build something that works for them, but do it in a scalable architecture so we can replicate it very quickly into other communities. And
if it works there, maybe it works in other places, right? And that's maybe how we get adoption.
Well, exactly. And I think that's at that community level. It's all about the tragedy of the commons. So there's fascinating research by a Nobel Prize-winning Ellen Ostrom, where she studied systems where you could avoid the tragedy of the commons, where you could actually get people acting independently to look after shared resources, and she sort of defined these certain conditions. And so we want to sort of bring those principles into play so that we can incentivize communities to actually look after sort of collective well-being.
That's cool. Awesome. Well, thanks very much, Mark, for joining me today. Now, if people want to reach out and follow what you're up to, what's the best way for people to get in contact and follow you?
I'm not a big Twitter man. LinkedIn, I probably should get back on Twitter, but sort of email Mark at the DAO, so THEDAO.agency is my email. I post quite a lot on LinkedIn, but feel free to drop me an email, but we will get our social media going soon.
Fantastic. Thank you very much, Mark, for joining me on the NZ Everyday Investor, and we'll catch up with you again soon.
Okay, my pleasure.
All right. Cheers.